All right, good morning, ladies and gentlemen. Welcome to MACROACE with your host, Tony, going through non-farm payrolls. I'm also the head financial analyst at FinancialJuice as well. So non-farm payrolls paired with the Canadian employment change data. We'll go through first with non-farm payrolls, so let's get into it. So what is non-farm payrolls? It represents the net amount of jobs created in the prior month. You have two surveys, the household survey, which represents the unemployment rate figure. And then you have the establishment survey, which surveys 666,000 corporate and government work sites. Then how does it affect the economy? Very simple. With the currency, if you do get better than expected non-farm payrolls data or jobs data, that usually gives a bullish or positive sentiment for the currency. And you would see the appreciation. One of the reasons being is that the economy is adding more jobs and the labor market is healthy. The other reason is that the central bank might decide to raise interest rates further, depending on how strongly they feel about the jobs data and how that will affect the monetary policy in the current situation and then in the future as well. For the stock market, we're going to be keeping an eye on the futures. But usually for the stock market, when you do get better than expected payrolls data, that's in a non-tightening environment where the central bank isn't hiking rates because of strong data or strong US economic data, then the stock market would usually see an appreciation in the expectation or in the hopes that a strong number of jobs that have been added to the economy continues to provide momentum for the rest of the economy further down the line, i.e., if you have more people in jobs, then there is an increased chance of spending, and then that spending leads to higher stock valuations and also means that productivity picks up as well. You would hope so, with more jobs being added. So that's a positive for the stock market. On the flip side, though, is that in this tightening cycle, when the Federal Reserve is laser-eyed focused on inflation and the job market, that if you do get a stronger than expected report, what can happen is then the stock market actually sees a depreciation and you see the futures taking a hit, the stock indexes taking a hit instead. And then that leads to repricing of where the Federal Reserve is expected to end up with their Fed funds rate or any other expectations of what future data could possibly be like. So you see a pricing of what to expect in the future and also reaction from the data itself in the short term. Then for the bond market, if you do get better than expected data in a tightening environment or even in a non-tightening environment where nothing is going on, if you do get better than expected data, what happens is the bond yields see a rise, as that shows that the economy has a healthy pickup in the amount of jobs that are being added, or the economy is resilient to, let's say, the Fed's interest rate hikes. And what that could mean, so as I said, bond yields would see a movement towards the upside. Bond prices on the flip side would see a decline. Then going on to the indicators then that are weighing on sentiment at the moment, how does the US economy look like overall? What are the different things that we need to be aware of? So we have inflation at 3% compared to 3.4%. Don't forget CPI next week for the US, that we're also going to be covering. PC price index year on year was at 3% compared to 3.8. GDP Q2 was at 2.4 compared to Q1 of 2%. Unemployment rate is at 3.6 compared to 3.7. ISM manufacturing employment index was at 44.4 compared to 48.1. So a marked decline in the manufacturing sector for the ISM report. The manufacturing report itself did see a tick up to 46.4 compared to 46. ISM services employment was at 50.7 compared to 53.1. And then the services PMI was at 52.7 compared to 53.9. JOLTS as well was at 9.84 million compared to the prior of 9.582 million. So not too much of a deviation or difference or any real worrying signs that the US economy is faltering. But again, one of the other key reports that traders are looking at for expectations of what the jobs data could look like in the future. Employment cost is up 1.2% compared to 1%, and ADP employment change was at 497k versus 324k. So keep an eye on that. We're going to be discussing what the market reaction was like for ADP and what it could mean for non-farm payrolls for today. Now, going on to the triggers then for non-farm payrolls and the figures that we get for the employment data as a whole. So non-farm with a high estimate, according to economists, what they're looking at of 300k for the actual figure. So that's a deviation of 100. So 300k for the high estimate with a deviation of 100k and a low estimate of 150k. So about a 50k deviation there. Unemployment rate, they see a high estimate of 3.7% compared to a low estimate of 3.5%. Average hourly earnings, that's going to be very key for this report too. If you do see wage inflation picking up steam or that it is higher than expected, that's going to or could moderate how strong of a reaction that there is, or it could accelerate or make the reaction stronger. Either way, up or down, within each of the different assets that we'll be taking a look at. So they have a high estimate of 4.3% compared with a low estimate of 4.1%. Private payrolls, there's a high estimate of 265k with a low of 100k. And then if we go on to the previous report that we had seen then from July 7th, so sectors with notable growth included government, healthcare, social assistance, and construction. Average hourly earnings rose by 0.4% for all employees on the private non-farm payrolls, with a 4.4% increase over the past 12 months. Then Fed and government views. So we had Fed's Barkin said that it is still a question whether inflation can settle while the labor market remains as strong as it is. So again, going back to what I said earlier, that when you do have a strong labor market, there is the tendency, or there is that correlation, that there are more people that are in jobs. That leads to more spending, and then that leads to prices going higher for the same amount of goods within the economy, or goods and services within the economy. Of course, there are other external factors that affect the price of goods and services, but that's one of the links to also be aware of too. That if you do have a strong jobs market, then that means that there is a higher chance of more consumer spending within the economy, and then that leads to inflationary pressures that continue to build. From the Fed's Beige Book, they said that employment increased modestly this period, with most districts experiencing some job growth and labor demand remained healthy. Even with how far we've come along with the Fed's tightening cycle, that is still the case, that businesses haven't really been, their hiring process or their hiring hasn't been completely thrown off by the Fed's hiking cycle. Fed's Waller said that while the labour market has slowed, it remains quite strong. Yellen said the labour market is cooling without any real distress. Fed's Powell said labour demand is still substantially exceeding supply. And Fed's Goolsbee said that price inflation indicates what will happen on wages, not vice versa. So that's one thing that I did talk about yesterday in the stream for Apple and Amazon earnings. If you did join me live for that there is the view that if wages do increase, then that causes inflation to go higher. Now, what for Fed's Goolsbee is saying here is that if inflation is higher, wages are then affected. So we've got to think about it this way. If wages do go higher, businesses are not going to immediately start raising their prices that quickly. It depends, unless there are some very drastic situations where that could happen. Particularly at the center, or say the middle part of the Federal Reserve's tightening cycle, where inflation was still quite high and quite sticky. But before that happens, you have the external factors that will affect the businesses that are providing those goods and services. Maybe it's input prices that have increased. You have other factors such as supply chains being hampered. Maybe businesses aren't able to get their hands on the goods that they need to then make the finished goods, or provide the final bits to provide the services that that customers need in order to remain in a healthy situation. So what happens is that prices start to rise as there is more demand and there is more scarcity for those goods and services, businesses that require those pieces that they need to form their business. And then from that inflation, then it goes on to the consumers, where prices start to rise. So if you think about PPI data, right? If PPI data comes in higher for 1 month, or much higher, let's say there's a 5% jump in PPI, you're not going to see businesses start to raise their prices as soon as or the following month. Usually, of course, businesses would want to try and keep their prices stable, and any changes in those prices would be minimal, unless there are very drastic situations where over a period of time, at least 3 months or so was what analysts talk about, if PPI data is much higher than expected and producers are paying more for the goods and services to then pass on to consumers, then there is a chance of inflation. Then there is a chance for inflation that starts to tick up before you even think about wages too. Okay, so what we need to... But that doesn't mean we should put off the wage inflation data altogether, because the Fed is still focused on that. And then it's not to say that that's not going to have an impact on inflation and where it ends up, or how strong it becomes, or if it becomes weaker. It is still quite important for the Federal Reserve to keep an eye on all those different indicators of inflation. Investment bank and research views. So you had S&P that said that the US labor market is slowing to a more sustainable level. Payroll jobs continues to grow at a relatively strong pace. Bank of America today, what they had said is that banks' private clients are fleeing equities amid fleeing equities amid lingering of risk of a recession. Private clients were net sellers of stocks for a second straight week in the 5 days through Wednesday, while bond purchases were the strongest since October in the past 2 weeks. What do I mean by that? And what do they mean by that? And what could it mean for the markets today and how the markets react? Let's say that the sentiment shifts where traders go into a risk-off mode because there is the expectation, or there is a heightened sense of an oncoming recession, and there is fear that grows. The key economic releases traders usually look out to is the job market. Does the job market hold up to, or is the job market propping itself up within a recession, or getting close to an onset recession? If you do see a labor market that starts to falter, what happens is not only does the dollar decline, but the S&P 500 could also see a potential decline as well if recession fears start to hit the market, and then you start to forget about the release itself, and then you have a risk-off sentiment that that starts moving the market into a more of a bearish stance. So that's one of the things to be aware of for today's non-farm payrolls figure, that if you are starting to see clients just from Bank of America that are starting to shift themselves towards more safe haven assets, then that could be a cause for concern for the rest of the market, not just the stock market, and of course what we're going to be covering today. Men Bande said, what number would trigger this risk off? I think that's a very difficult question. It's a very difficult question to answer. I'm not going to be able to say whether or not there would be a risk off reaction, because you'd have to have a multitude, or not just one release for data to look at. You need quite a few bits of data to look at least. you would at least need at least 4 months or so of data of negative non-farm payrolls figures, and then see how that affects the rest of the economy, and what kind of ripple effect that has. So if you do get weaker than expected figures, okay, not just talking about comparing it to the prior, then that could then change the shift of analyst expectations of where they see the jobs market in the future. If it keeps missing their expectation and it keeps going towards the downside, and then you might get more bearish comments from those analysts, and then those comments then start to, as they sifted their way through into the rest of the market and the traders and investors as well, then that has a knock-on effect on everyone else. All right, but you can't really put it on one figure. So this is what I want to talk about with ADP. So last time round, there was, if I believe it, so with ADP, when there was a positive figure, what we'd seen, we had seen a negative reaction. If you're looking at the deviation sheet, you can pull it up and we can have a look here, how the markets had reacted in the past. But if I just bring it up here for you guys, so you can see that when there has been a positive figure from ADP, from the ADP employment change data, that there's been a negative reaction in the stock indexes and the futures. And the dollar has seen a more or less robust, I'd say, market reaction, particularly on the dollar yen, which usually sees the biggest market reaction. So what does that tell us about non-farm payrolls? So with non-farm payrolls, what we're expecting then is that if you do get a stronger than expected figure for non-farm, that you could see the futures, stock indexes taking a hit and the dollar seeing an appreciation. So what we've seen here, when the data completely blew past it, there was 134k deviation for ADP. Better than expected data. Dollar yen had seen an appreciation, gold declined, bond futures for the 2-year ZT had also declined as well, and there wasn't too much of a market reaction from the S&P initially, but there was still a decline off of the back of that data. So what traders sometimes try and do is they try and use ADP as a way to forecast what the number would be for non-farm payrolls, or whether it be positive, or whether it be a positive figure or a negative figure. There isn't really a clear correlation or clean correlation where if ADP does come in higher than expected, so will non-farm payrolls. The correlation is very, very weak. Every so often you might get both bits of data pointing in the same direction, but rarely do you get that. The way we should think about ADP and how we should use it is, what is the market reaction like? Okay, if the market reacts, if the dollar reacts in a positive way and the rest of the market, stock indexes and gold and bond price and bond futures are reacting in a negative way, that could give us a hint as to how the market might react for non-farm payrolls. And again, I'm not saying, if you think I'm going to say how strong it is. No, I'm not talking about how strong the market reaction is. I'm just talking about which direction the market could go. Hopefully that's kind of clear for everyone. If that's not, we've got about 10 minutes left. But that's what happened with ADP, and just something to be aware of. So if we look at the last market reaction that we had, then we'll also be looking for the Canadian data too at the same time. So this is about 10 seconds, or less than 10 seconds before the last release that we had back in July 7th. So you can see when the data came out at, it was a negative bit of data, the dollar tanked, and you'd seen that the stock indexes had seen an appreciation off of the back of that. And for the Canadian data, which we'll talk about in a little bit, but you can see for the Canadian data was stronger than expected here. But what had happened is that there were some other areas that, if we're looking at some other areas for Canada, that weren't as as strong as expected. Actually, I take that back. The Canadian data was more or less solid. There was a decent deviation for the Canadian data, but it was the US data that had an influence on how the Canadian dollar performed. So that's also another thing to remember. If you do get, let's say, really positive US data, really negative US data, because the Canadian dollar is, of course, dollar denominated, or dollar denominated currencies will take on a knock-on effect to how the US dollar performs. So that's one thing to be aware of, is that if you do get very negative US data and the dollar tanks, that's going to moderate how much of a reaction you get, or positive reaction, let's say, you get from the Canadian dollar and other dollar denominated currencies. So that's one thing to be aware of. But let's say if Canada smashes their figures as well, then you might see other areas with the Canadian dollar where it actually is able to hold its own and doesn't get too affected by the US data. Let's say that the US data is bad, but the Canadian data is really, really good. Then you could see the data. You could see the Canadian dollar maybe shrug it off. So there have been scenarios where the Canadian dollar has shrugged off the US data when it's coming in line with expectations, more or less. But then you have had situations where the Canadian dollar has had this sort of a reaction where it's actually weakened off of the initial data because of how the US data has performed. So that's one of the risks that you get when you have the US data and Canadian data at the same time that we need to be aware of. So if I kind of just skip ahead, let's go back to the markers there. Yeah. So let's bring up the Canadian prep now. I'm just going to give me a second, guys. Okay, so let's go through the Canadian data very quickly. So what is it? Employment change. We already know what it is. So I'll kind of skip through those little bits. So the previous report talking about how what were the key highlights. So wholesale retail trade was up by 33k, manufacturing plus 27, healthcare plus 21, transportation warehousing plus 10k, construction minus 14k, and education services minus 14k, and agricultural were the amount of jobs that were added were 6k less compared to the prior month. Okay, so the increase in June was seen as the largest since January 2023 though. And then where is the economy at the moment? So you have interest rates, which, well, of course, we have the interest rate for at 5% there, and then 4 compared to the prior 4.75. Inflation at 2.8% compared to 3%. GDP data quarter annualized at 3.1 for Q1, and Q compared to Q4 of 0%. GDP month on month is at 0.3% compared to 0%. And employment change, where we had last time, was at 60k compared to minus 17.3k. Unemployment rate ticked higher to 5.4% compared to 5.2. The S&P manufacturing PMI was at 49.6 compared to 48.8. So the triggers then for the Canadian employment change data: high estimate of 50k with a deviation of 25k, with a low estimate of 5k, so around again a 20k deviation, or you could even go for a 25k deviation for both figures. Unemployment rate, economists see a high estimate of 5.6% with a low of 5.3. And then sentiment and views then. So Bank of Canada meeting minutes, the Governing Council felt it was too early to tell whether wage growth was easing. Macklem said that the Bank of Canada doesn't expect a recession. So that could mean you could still get strong, or decent labour market figures from Canada. July 14th, he did also say that we need to see better balance in the labour market. We need to see wage growth moderate, and that was in an interview with the Globe and the Mail. And July 27th, you had CIBC talking about post-pay benefits employees, the figure release, which showed 23k people were part of or became part of the benefits from had started to receive benefits from their employers. So they said that data showed continued gradual loosening of labour market conditions, with employment excluding public administration rising only modestly and the job vacancy rate continuing to edge lower. All right, so investment bank views, CIBC sees the figure coming in at 25k, Scotiabank 15, BMO 30, RBC 25. All right, so that is that there. We're going to show you the deviations because I do want to kind of get through that quickly. We've got about 3 minutes left till the data. So if we look at the non-farm payrolls, then so the biggest market reaction of what we'd seen in the currency pairs was on the dollar yen, and has consistently seen the biggest market reaction that what we had here. And then if we're looking at the bond market, bond futures for the ZT 2-year being the most sensitive to market reactions had seen the biggest market reaction there. So for non-farm payrolls, bearing in mind, of course, with a bigger deviation that you would expect. So if economists are looking at a 100k deviation, I think that sounds right for both sides, whether it be higher or lower. But then we also need to be wary of the average earnings data too. And then whether or not the sentiment has shifted from good data is good data or good data is bad data for the stock indexes or for the stock market. And how the stock market will take that and what pricing that we will see for the future. So that's non-farm payrolls. So again, as I said, looking for 100k either way for for the headline figure itself. You'd also want the data to be in line with you'd also want the data to be going down in one direction, i.e., all the data is either higher than expected or lower than expected, and then you get a cleaner market reaction. Whereas if you'd start getting what we see here, where maybe the headline figure is much better than expected, but the unemployment rate starts to tick up, then that causes some issues where there might be some mixed volatility within the market. And the market reaction might not last that long. So you'd want data going in one direction, like we'd seen back here in February, where everything ticked in one direction. Okay, and the Canadian employment change, we know that the biggest market reaction has come from generally between these two here, GBP-CAD and EUR-CAD. We've got less than a minute, peeps, so let's get on to the release. Let's get CAD JPY. Let's get that up on here. Okay. See what happens. Okay, 187k, 187k, lower than the forecast of 200k. Average earnings 4.4%, 4.4%, higher than the forecast of 4.2%. Canadian employment change minus 6.4k, minus 6.4k, lower than the forecast of 25k. Private payrolls 172k, 172k, lower than the forecast of 180k. Just keeping an eye on the market so far. So the Canadian dollar seeing some weakness now. Of course, that's so going back into the negatives there with data at minus 6.4k. The unemployment rate remains unchanged at 5.5%. The US unemployment rate ticked lower to 3.5%, lower than the forecast of 3.6%. Then if we look at the US labor force participation, 62.6% as expected. Canadian participation rate, 65.6%, lower than the forecast of 65.7%. Canadian average hourly earnings of 5%, so that ticked higher, compared higher than the forecast of 4.1%. But you can see that there was the initial mixed reaction from the markets there, off of the back of that data. So what does that kind of tell us? Well, it wasn't a complete clean wipe, and the data was more or less as expected. So just keep an eye on which direction the market wants to go. See what we get. Okay. Let's see. Yeah, this is not a nice release. It's quite choppy here. Whipsaw reaction from the data. Cool. Make up your mind which way you want to go. All right. So we'll see if it does go past this this initial wick here on the S&P on stock index here. So data was as more or less, there wasn't too much of a deviation there from Nonfarm Payrolls. The unemployment rate did tick down, however. This is some bad juju. So looking nice. What do you want to do? Okay, just looking at other areas. Average hourly earnings did tick up to 4.4%, so that's also causing some mix of confusion there within the markets. Again, no real clear direction being provided. All right. Okay. It's not having fun. Yeesh. Probably. See what the NQ's doing too. Right. So is TICKSTRIKE giving us some? Probably needs to make that a bit higher. Okay, let's do some market reaction checking here. So, okay, so the dollar is still, so what I want to do first is measure the initial market reaction. Okay, now getting somewhere. Right, cool. Right, let's go. Just let TICKSTRIKE do the rest. Now we're seeing a direction. All right. Fly, baby, fly. All right. Okay. All right. Hasim says, thanks for the coverage. Thank you for joining. And joining me live for it. Let's get out of that one too. All right. So don't forget, so we have the data coming out live in real time on the FinancialJuice news feed. So if you're unfamiliar with what FinancialJuice is all about, so first of all, also don't forget, if you like the data and if you like the prep, well, let's say if you like the prep, then don't forget to give us a like and subscribe to our channel as well. But so let me go through what FinancialJuice is all about. So FinancialJuice, what it does is it allows you. So what we do here is we give you the up-to-date information of what. Sorry, just keeping an eye on stuff here at the same time. Just what it does is it allows you to understand what's moving the markets. It keeps you in the know about what's moving the markets. What is the top bit of news that traders are keeping an eye out for? If there is let's say, if there has been a commentary from Fed's Powell that has said something very important about monetary policy and the future expectations for it. And also, sorry, apologies, guys. I'm kind of going backwards and forwards here. So yeah, so if Fed's Powell says something very important and that's having an effect on the market, if you're not keeping an eye on what's being said and you see the market going haywire for some reason, then having a live voice and text service is there to make sure that you are provided that up-to-date information. So then you can make your informed decision as to which way you would want to go with your trade, or manage your risk, or capitalize on potential moves here and there from the markets and the news that has been provided. So that's the key thing about FinancialJuice, is providing you with a live, real-time voice and text of the market moving news in real time. So there is so again, what I'll do is I'll put this in the link in the chat here for you. So what it is, so there we go, there's a link there. So what we can do is sign up for the light version of FinancialJuice if you've never come across a live version, or if you've never come across a voice news or live voice and text service before, if you've never used it. You can see here on the FinancialJuice news feed, you have your voice news that is played here, and you also have your economic calendar on the left hand side here for the economic data. And then you have your news feed here in the center as well, of giving you the up-to-date news as well of what's being said. So you can see here we're also charting the data here as well, as soon as we can, to give you guys the update information how the markets have reacted, if you were catching up on what's going on within the markets. Okay. Right. So one of the things to be aware of then is when we're looking at Financial News with FinancialJuice is that you have usually it's the big boy traders that have access to, or the professional traders that have access to a live voice and text service. So then they can manage their risk and capitalize on potential trades. So if you wanted to sign up for the pro version of FinancialJuice, so let me talk about the difference between pro and light. So the pro version of FinancialJuice doesn't have any adverts playing. There is no delay to the voice or text news feed that we have, and you're also able to ask here on the news desk questions about about what's happened in the markets, why the market's moving in a certain direction, and if there's any other bits of news to be aware of, or if there's any issues that you may have with your account on FinancialJuice. So that is that there. So as I said, you basically have there is no delay to that. The live version still pretty useful if you've never come across the live voice and text service before. Still pretty useful to kind of get a handle on as to how to use live voice and text service. But again, as said, day traders, those who are scalping the markets for those opportunities, jumping onto that volatility and the opportunities that are presented, that's what it's made for. Those are the people that is made for. So that's there. Now, if we're looking at the deviation sheet again, so the deviations for the economic release, what we had. So the deviations for the economic releases that I'd shown you guys, showing you how much the market had reacted to the economic releases. That's also available too for users. That's completely free. And all you got to do is sign up to the MACROACE mailing list, which I'll pop in the chat here. Okay, there you are. And pin that for you so everyone gets it, if it lets me. Okay, that's pinned there. So with the MACROACE mailing list, all you get is one email every Monday of the live stream links that we have for the week ahead. A short summary of what to expect within each of the sessions in Europe, US, and Asia. Very, very brief and short because I go through details about the economic releases with you here in these live streams that I do with you guys. But you also get access to the deviations Google Sheet as well. As I said, it's completely free, no charge to it, and it's something that you can, of course, utilize and have a little play with as well. All right, so that is that there. So that's with MACROACE there. It doesn't look like it wants to hold. Also, whilst you're looking at the screen here at the same time, we've got TICKSTRIKE. So what does TICKSTRIKE do? TICKSTRIKE allows you to listen into order flow of different assets in stocks, futures, Forex, crypto, ETFs and ETNs, and your internals like the VIX. Okay, all at the same time. And the reason why, again, if you're a day trader, if you're scalping the markets, again, that's another useful tool that for day traders that they can have at their hand. So another way to put it, it measures the strength of the buying or selling momentum that is presented within the markets. M. Bande said, just went on a roller coaster before I close at break even. Damn, son. Yeah, it is a choppy market. It's not nice. It ain't nice. But yeah, so as I was saying, if you wanted to use, see what is the buying or selling momentum like within the markets, and whether or not it's something for you, is if you scout the markets to capitalize on those potential trades, or if your date when you're day trading, then that is TICKSTRIKE there for you. So this little box here, bring this away. So this little box here, you can see here that you have, so what is gold? So this little box called the ticker represents the asset that you're looking at. And this plus symbol shows the buying momentum. And then the flip side with the minus number would show you the selling momentum that has appeared within the markets. Okay, so what do these numbers mean? So what this number means here, number one, or what does this slider mean? So number one shows you, number one is whenever there is a market reaction, a little bit of a market reaction here or there, then you'll see TICKSTRIKE giving you an alert, like it is here, visually and audibly as well. If you wanna do both or one or the other, okay. And if you increase that slider all the way to 15, 15 is the least sensitive, to market reactions. Only when there's a big amount of buying or selling momentum that occurs within the markets do you see TICKSTRIKE give you a visual or audio alert. It's quite interesting. Okay, so it's let's see what's going on here. Let's get okay. Let's keep an eye on that there. Gold, however, just flew past its initial market reaction. Says the rest of the market to the dollar yen, kind of still holding at the bottom. Let's see. Let's go. Right. That's the bottom over there. Okay. That's holding. Okay, so TICKSTRIKE, let me give you the link to that there for the 7-day free trial. That is there in the chat. Apologies if I'm kind of going in between talking. Keep an eye on what the market is doing. Okay. Yeah. All right. Anyways, ladies and gents, thank you very much for joining me live. Don't forget to like the video, subscribe to the channel, get the word out there if you found the information useful, and subscribe to the channel. And I will see you guys next week for CPI brothers or sisters. So both you guys, I will see you guys next time. All right, take care.